This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Minnie Ingersoll, a partner of TenOneTen Ventures and host of the LA Venture podcast. Minnie, thank you for joining us.
Thanks, Hal. Glad to be here.
Right. So what was your background before investing in early stage companies? What did you do before this?
Well, I was an early stage company. So before I was at TenOneTen, I started a company called Shift. This is 2013. And Shift is an online marketplace for buying and selling used cars. And started that with my co-founder in his apartment, and then raised $100 million and marched up and down Sand Hill Road a number of times and really got to know venture capital from the point of view of asking for money. And before that, I was a product manager at Google.
That's great. That's great. So what excites you right now?
A lot of things excite me. Some kind of terrify me, but I think exciting is the state of entrepreneurship in our country. When I look at sort of what's going on in our country, I think there's a lot of things that aren't working. I think our federal government right now is not working. Our education system has problems. Our healthcare system has problems. There are a lot of things that have problems, but actually entrepreneurship is just booming right now. And I in LA, and the universities are all teaching entrepreneurship. And it's become something where I think people feel really empowered to take control of their careers and do sort of set off on their own path in ways where when I was growing up, but it was much more of a black box if it was even discussed at all. So I'm quite excited for that as just a driver of our country's sort of future.
Well, great. It seems like now's a great time as the country does a reset and there's a whole new set of careabouts and new technologies coming up that we need entrepreneurship to carry us forward here for sure.
Yeah. We're all sheltered in place at this moment. And I've just been seeing so much entrepreneurship around COVID. And so 2 nights ago, I just judged a Hack for Hope, really sophisticated hackathon. Like I've been to a lot of sort of hackathons that aren't meaningful. And this was probably the best hackathon, but best solutions, best products coming out of that. So exactly. I think that we're able to mobilize and there's people with the skills in the country and they sort of have the ability to work on things that matter, which is exciting.
Well, that's great. Well, you see a lot of startups out there. What's your advice for people investing in startups, say first timers? What do you tell them to do before they write that first check?
Okay. Well, so people interested in getting involved with writing checks, I often tell people to start, if they can, maybe writing small checks into syndicate type deals. So actually, rather than writing a small handful of checks that are larger, in the $25,000 range, if they can, getting a portfolio of 25 companies by writing $1,000 checks and just getting exposed. Like my best sort of investing is the more you see of it, right? Who is it? Malcolm Gladwell in like the 10,000 hours or something. But if you're just sitting on the syndicate list, if you're just seeing tons of startups, it's hard to know if something is a good investment. But if you've seen 1,000 companies similar to it or 100 companies similar to it, it's easier to sort of stack rank which look the best in comparison. So that's usually my advice. And of course, if you know someone is great, there's a lot of people that you come across in life where you just think, I would like to own equity in that person's future success, which sounds sort of crass when I say it, but investing in the people, which is what everyone says, but I think it's completely true.
Well, that's great. And then for experienced investors, those who've been doing it for a long time, what's your coaching to them in these days?
Well, I'm new enough to the investing side. One thing that I hear everyone say is we invest in great teams. And yet a lot of the sort of pitches that I sit in, neither the entrepreneur nor the investor talk that much about the people. And I think the idea is that it's sort of a proxy, which is if we ask you about the assumptions behind your forecast, your 5-year model, we will see how you think and we will get to know you. But I actually don't see enough of just asking people more about their background and what they would have done differently in their previous role. And I think people ask about like, what was the genesis for this idea? But I've had my whole career has been on the operating side where I've done, I don't know, maybe 5,000 interviews for hiring people in the early days of Google. And I think I sort of treat venture capital, early stage venture capital, as a little bit more like interviewing people for a job, which is you're asking them, tell me about a time when, that sort of stuff.
Well, that's great. Yeah, team is always the most important. And in good times, it's, everything goes well. That doesn't really tell you much. But when they're under the gun and in challenging times, that's when you learn what people can really do. So those are good questions to ask for sure. So on the other side of that table, what's your advice for people running startups? What do you tell them to do before they launch that first startup?
Yeah, I think that probably the biggest advice I give people, which is a little ironic, is to think for themselves. And, it's always funny to take that advice from someone. But I think that there's mostly, I think, a huge benefit that startup entrepreneurship has become less opaque. I think that's a benefit for everyone, which is to say that entrepreneurship is, as I said, being taught in universities. But I think that means that people tend to follow a little bit of a formula and they think, oh, the investors want to see this, or I'm expected to present the market size by, making a slide that has the TAM and the TOM and the SAM, as opposed to just thinking for themselves, like, what do I most need to build for this business? What's the thing I really have to do right now to move the ball forward? And then doing that thing and building the business based on what they, in their most honest selves sort of think it needs to be done, as opposed to kind of what does the VC want to hear. And then, of course, hiring well is the other advice that I give people a lot. And I think that sounds trite in a way, but my lesson of hiring well is to spend, I don't know, a third of your time doing it, and then you will do it well. But you just can't hire well without dedicating a huge amount of time to doing it. And then, of course, you mentioned at the top of the show that I host a podcast. And the reason I host a podcast is primarily to help entrepreneurs, because I think, like your podcast, I told you I'm a listener. I think it helps to get to know the VC before you are trying to raise money. And so much of the time, I think entrepreneurs approach the wrong people with the wrong pitch. And so I do think it's very useful to get to know what someone invests in and what sort of advice people who've done it before are sharing.
Great. So let's talk about the state of investing in startups. How do you see the industry evolving these days, and what changes do you see coming up?
I'm a seed stage investor. And so one of the things I'm thinking about a lot is sort of who's upstream and who's downstream. And it's been interesting for me to kind of think about the role of upstream investors, as in, for me, it's usually like accelerators, and how are VCs adding value. And I think right now, there's been a change even since I was fundraising in 2013, which is, I think a lot of the early stage investors are offering sort of a menu of services. Things like, not only will they help you raise your next round of funding, but they'll introduce you to mentors, will help you with your go-to-market plans, et cetera, et cetera. And I think that that's actually putting a real squeeze on accelerators to be able to sort of command the premium ownership. And so, I'm also in a market outside of the Bay Area now. I was at Google for 20 years or something, no, 12 years in the Bay Area, and I moved to LA. And being in different markets also, I think, has a lot of sort of, I think that's just changing. I just think it used to be that you had to move to the Bay Area to launch a startup. And now I think people are doing that in markets outside the Bay Area. And that's a big change for the better.
Well, great. And so what do you think about what's the biggest change you see coming up at this point for the state of investing? Where are we going from here?
I don't exactly know, but I think that, at least the thing that I want to keep doing is listening to what the entrepreneur needs. And I think that that's kind of the most important thing that most investors can do. I think there's been this move towards everyone's trying to differentiate themselves. And some of it, I think, is the differentiation in terms of what they offer to entrepreneurs, or, what their focus area is. And I think that some of that is hokey and some of it is really about understanding what what entrepreneurs need next. In LA, where I am in the seed stage, I see a lot of people who are able to get a fair amount of interest and commitments, but don't have anyone to lead deals. So we're leading a much larger number of deals than we used to lead. But that's sort of one small example, and I'll be interested in sort of continuing to listen to the market.
Okay, great. So let's talk about the investment thesis for your fund. What exactly is it, and where's your focus?
Yeah, well, we're focused on software and data companies, which leads us to mostly be investing into B2B companies because our sweet spot is not consumer companies where brand is their moat. I often say that if software or data is the moat, is the thing that makes it sort of hard to replicate, then that's a sweet spot investment for us. And that often means that it's like an engineer turned entrepreneur. That's sort of our sweet spot, in large part because my partners and I we all have tech backgrounds and have been engineers and been entrepreneurs. So that tends to be where we at TenOneTen are investing.
Well, great. And so what kind of startups fit that thesis? What kind of companies are you looking for? And do you have a particular criteria around revenue or sector or stage?
Yeah, businesses that fit that. So stage, we're pretty squarely in the pre-Series A stage. And I've been an angel investor. And now that I'm on the venture side of things, there's a lot more thought that we give to portfolio construction. When I was an angel investor, there was much more of I want this to return my money, double my money, but I wasn't thinking about it has to return the fund. And so we do tend to be Series A because that's where we're able to get the ownership that we're looking for. And right now, I think in the sort of post-COVID world, I think that we're seeing a lot more companies that might even have been called Series A, but are now more like a second seed round. And so that tends to be our sweet spot, is the second round before Series A. And I think most companies nowadays are doing at least 2 rounds before a Series A.
Yeah, I guess we used to call those seed and seed plus because people have to get ready for a true Series A, get the KPIs in shape, and that can be really hard to do on just round of seed funding.
Yeah, but now there's pre-seed, seed plus or something, right? So often there's different number of rounds, but we're kind of in one of those later rounds that's pre-Series A. Although back to great teams, we'll invest earlier if it's an amazing team, especially if it's someone we met before or fits our investment thesis well.
All right. So let's talk about the startups you work with. What do you think the main challenges are startups face in launching their business today, aside from the usual issues of finding team members? What do you think the issues are?
It varies a lot. I would have said, finding team members is hiring well. I mean, hiring anyone, but especially really strong technical talent is a big one. I think that right now, I think the world is fairly frozen, and I don't think that that's going to end, say, by the end of this year. Like, I think Q4 is going to continue to be a really hard year or a really hard quarter for people who are selling into the enterprise. And then I think there's always the emotional roller coaster nature of startups is hard on a lot of people. And we see that a lot. And I experienced that a lot myself at Shift. Many things that now in retrospect don't seem so bad, but at the time were extremely hard to get through and sort of trust that it was all going to be okay.
Very good. And so on the investor side, what do you think the challenges are the investor has at this time?
I mean, generally, I think it's a much easier job to be an investor than it is to be an entrepreneur. But they're very hand in hand, right? They're flip sides of the same coin, especially at the seed stage. But for us, I would say my team is a bunch of sort of nerds turned entrepreneurs, now turned venture capitalists. And I would say the thing that surprised me the most about being a VC is how much of a sales job it is. None of us have any background in sales, and yet you're constantly selling other investors on your portfolio. You're raising money. It's a lot of pitching, really. And so that's kind of hard. But again, I go back to fundamentally, if there's great entrepreneurs, it's a much easier job. So like for us, we're based in LA, but we're not exclusively an LA fund. But our success really depends on having great people building companies in LA.
Great. And how about raising
money for the fund. What's that like?
Oh my gosh, it's new for me, but very difficult, I would say. And I think that with the crazy market volatility of late, I think I worry about sort of the ripple effects that will have on the VC, the seed stage venture capitalists being able to raise funds, which then mean there will be fewer seed funds to invest into the seed stage entrepreneurs. So I am quite worried about that. I'm very optimistic about the state of entrepreneurship, but I think there's a lot of entrepreneurs who struggle to raise money. And I think there's a lot of GPs who struggle to raise funds. So, and it's also just very time consuming.
Sure. Well, certainly the markets, when it's going up and down, is distracting limited partners away from funds and what they should be doing. But aside from that, what do you think is the main challenge in winning over a limited partner to your fund and getting them to sign on with what you're doing?
Well, I think that the challenge that I think a lot of GPs talk about is that when you're an entrepreneur, once you get one term sheet, you're kind of done. You get your term sheet for your Series A and you have some other people participate, but pretty much you get one term sheet, that's it. And a lot of fund managers, GP friends, they have 60 LPs in their fund. And so they have to get 60 yeses, not one yes. And I think that's just a challenge to get 60 yeses. You have to talk to, at least some multiple of that number of conversations you have to have.
That's a good point. You have to sell many investors, not just one. But on the other side, you're experienced at fundraising, so you bring extra skills to the table. What's your number one skill you think you have to have for closing limited partners?
I mean, I'm sort of believer in the meritocracy. So I'm still mostly a believer that if you do great investments, your track record should to some degree speak for itself. But I also just think it's kind of like hiring, which is you have to dedicate a whole lot of time to it. And to close 60 people, that means you're lining up a whole lot of meetings because those don't happen in one meeting. And you're, flying around the country, if not the globe, having those meetings. And so it's time and hustle too.
Well, it's good advice for startups. It's time and hustle, and it takes both to win the game. So it seemed like that's just true for everybody at this point. So you see a lot of different applications and sectors out there. If you had to pick one or two that were really top of the list for investors to pursue in this economy, what would you put at the top?
I mean, I've always liked health tech. So that's certainly one that has been completely disrupted in focus of sort of our current era in the sort of era of COVID here. It's just there's both sort of so much low hanging fruit in terms of things that could be improved. But also right now we're all staying at home and everyone is learning how to do their health online and via telemedicine. And we're all learning how to do that with our education system as well. And my anecdotal evidence is that no one is saying, oh, distance learning is great. I want to keep this and stay with this model. But a lot of people are learning the benefits of what they can do with telehealth and digital services in the health space. So I think there's a lot of interesting things going on there. We have some investments. We have an investment in an AI for physicians tool that's doing really well. So I think there's a lot. I'm looking at a company in stress reduction right now. I think there's just a lot of interesting stuff in health. But for us, our investment thesis also does tend to be around interesting technology applied to big legacy industries that don't have a lot of tech. And so we do primarily want founders to come to us with their ideas and to share with us what we should be looking at. And so we have an investment in a debt collection company, for example, which, if you'd asked me to put down the list of things that I am like setting off to invest in, I don't think I would have put debt collection via text message. And yet it turns out they're a wonderful company, True Accord, in our portfolio. So yeah, I think there's still a whole lot of interesting opportunity.
Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I think just acknowledging like these times are really stressful. I think entrepreneurship is always stressful, but we're having a lot of conversations about RIFs, how to do a reduction in force, which unfortunately I had to do once at Shift. we had to do it. And then it turns out that after we did a RIF, our company survived and thrived. So I'm trying to help people just have those conversations, because I think a lot of times the stress can be a little bit allayed by just talking it through. So, I think that's a big one. And be remiss to say I'm not like trying to do the same on my own podcasts and asking my guests about how they're thinking about things like their reserve allocation right now and how they're sort of supporting their portfolio. That's something that I think this is sort of the time where VCs are earning their management fees. So yeah, I've been giving that a lot of thought.
Well, that's great. So how best for listeners to get back in touch with you?
Yeah, I'm probably LinkedIn is probably the easiest for people. I'm the only Minnie Ingersoll, but I'm pretty obvious on LinkedIn. The podcast is LA Venture. People welcome to reach out to me. Twitter as well. I'm Hi Minnie at Twitter.
Great. We'll put those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Absolutely. Thanks, Hal.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Haltine Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.